Where in international markets are you seeing the opportunities? Because at the same time, I'm seeing in your notes and you actually think the dollar will continue to gain ground.
Yeah, I still think that with the dollar, we want to stay defensive and long dollars here. Although we're doing that more through options than through cash. But looking at the international equities, what we have seen is a derating that's so big, it's a really wide discount to historical averages. I mean, 10 to 11 times forward PEs. That is still offering a really significant cushion versus bond yields. So I think that look, the eurozone and the UK have both cheapened a lot. Like taking a look at the UK, and I know it's a contrarian call, you're at a record discount versus other regions. A very high dividend yield, and basically benefits that are going to come from the weaker sterling here. So I think that international equities, you could have a moment. Well, even in China, we're looking at growth for the next couple of quarters at 5%. So given the contraction that was underway and that you've hit rock bottom on China, I do think that there are more international opportunities that stand out right now from a pure pricing point of view, valuation point of view. And in the U.S., I mean, the Fed is still sort of the key call, to watch, and there's still further to go there.
And of course, the midterm elections in focus here in the U.S. as well. We're hearing from Speaker Nancy Pelosi speaking to local media saying that Republicans will use a debt ceiling vote to cut Social Security. So when you're thinking about the Fed and inflation concerns and how much tightening they'll do, how does the fiscal side of things play into this equation, especially as we have the election results coming out?
Well, the elections at the midterms are usually a referendum, on the government, and the divided government means that we won't see new legislation passed. So I think a lot of the focus is going to be on oversight and investigations rather than necessarily what you can reverse. It's how well they can implement the agenda that's in front of them. And I think the gridlock that could be forthcoming is what the market's been responding to. That new legislation is very unlikely to go through. But I think taking a look at where the Fed is right now, I mean, we've seen such an aggressive move over the last 3 months, 200 basis points higher, for where we have the top end of the Fed funds target price at 5.2%. So a lot has moved over the last 3 months, but I still think the next Fed move is still another 50 basis points at least from here. That you don't see a pause until sometime in the first half of next year. So I don't see that you're going to be able to do that much more, on the fiscal side with a divided government. But I think the Fed is going to remain very much focused on labor market conditions, and you've had very strong labor demand that still has remained in place.
Joyce, an economic gridlock when it comes to a response from the policy side could also have an impact on the US dollar. Take a look at this chart in terms of this 3-day decline that we've seen, losing that support level. The next level that we're looking at for the Bloomberg Dollar Index is the 100-day moving average. So the steepest 3-day decline that we've seen since March 2020. Obviously, you still have the Fed in hawk mode, right? So how do you kind of weigh up the implications? Is it a risky bet at this point to be betting against the greenback?
Look, I still think it's going to be one where we look at the interest rate differentials, and we still think that the Fed remains as far as it's going to go maybe slower, but for longer. So a lot of this has gotten priced into the market, but I would not say that this is a turning point for the dollar right now. And I still think that in particular, EMFX here just isn't out of the woods. So I would still keep the defensive positions on. I do think we're at a phase, though, where bonds could start doing better than cash here, and that's one thing that we are more focused on. I mean, particularly as we look at some of the investment grade bonds in the U.S. right now, which are at yields right now that are very attractive.